there's this perception out there that once home prices start dropping, all the buyers are going to flood back in. But that's actually not what's happening in a city like Austin. In Austin, home prices are down almost 20% over the last 2 years. There's been no bounce back in buyer demand, and inventory is just continuing to increase. Prices now in Florida are really starting to go down in many markets. Buyer demand is not going up. In Boise, prices went down by quite a bit. Buyer demand really didn't go up. And so the other thing to understand is that when it becomes obvious in a housing cycle that we're in the down cycle, buyers all of a sudden realize that they have time on their side.
Mm-hmm.
And all of a sudden there's this FOMO or this competition that's gone. And rather it's kind of like, let's see how far the values could drop. And so, it's a bit of a long-winded answer, but I would be very skeptical of thinking that a couple rate cuts is all of a sudden going to propel the housing market forward when we're already seeing this big spike in inventory occur in about half the states in the US.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I find myself frequently repeating the advice that in today's highly bifurcated economy, it's critical to understand the difference between the mean and the median in order to get a true picture of what's going on. And the housing market is no different. On the mean or average level, U.S. home prices are at a record high. But in a growing number of markets, a number of them red hot until recently, prices are down by double-digit percentages. To make sense of the growing divergences and find out where prices are most likely headed from here, we're fortunate to welcome back to the program housing analyst Nick Gerli, founder of reventure Consulting and creator of the reventure app. Nick, well, look, it's always great having you on the program. We always have great conversations when you're on. I know you're on the road right now. In fact, I think you're in Miami, and I can't wait to hear what you're learning with your boots on the ground research there. But I also know that being on the road and doing this recording wasn't in your plan initially. So thank you for making the time both to do this and to find a place to record this. If we can, let me just kick this off with a variation of the question I like to ask at the start. What's your current assessment of the U.S. housing market?
Sure. Housing market is still in a record bubble. Home prices are 30 to 35% overvalued compared to their long-term norms. Like you said in the beginning, on a national basis, home prices are still climbing year over year. However, on a month-over-month basis, they are dropping in many markets, as well as a year-over-year basis dropping in many markets. And so the housing market right now is very bifurcated, and we actually have many cities that are entering a crash stage right now. This is what the mainstream headlines on the housing market are absolutely ignoring and missing, is the fact that in states like Florida and Texas, we are seeing a colossal spike in inventory and homes for sale. We're seeing a major sell-off take place that's now causing prices to go down, and I suspect this could be the start of a very large correction.
Okay, so start of a very large correction. You think that what we're seeing in Florida and Texas is basically going to become a contagion elsewhere in the country, correct?
More broadly, yes, but it really depends on your local market. I mean, there's certain states where I don't think home prices are going to go down that much. A state like New York would be one of them. Home prices aren't very overvalued there. Inventory is still very low. However, if your state is overvalued and if there was a lot of speculation that occurred during the pandemic, there's a huge chance that prices are going to drop. And so Texas and Florida, they're feeling it first because they were kind of the most speculative markets. But yes, it's reasonable to expect that this will spread to other parts of the country, although with varying degrees of how much prices go down.
Yeah, real estate is always a local phenomenon, but I just wanted to make sure that this wasn't something you thought was going to be contained to Texas and Florida. Doesn't sound like that's the case at all. So I want to tackle, if we can, just right at the start, some of the bullish pushbacks that people have been giving on the housing market right now, because we have this very strange housing market. It's very bifurcated, as you and I both said, but it also is kind of defying logic in the sense that historically there's a very indirect relationship between mortgage rates and home prices. We had seen mortgage rates going lower and lower and lower for much of the past decade plus because of Federal Reserve keeping interest rates so low. And of course, that led to much higher housing prices. And then we've had mortgage rates really surge over the past 2 years, and housing prices have still continued to go up. So that mathematical relationship has been broken, at least for the time being, right? Now, one of the pushbacks when people say, well, hey, it just mathematically is going to have to start coming down, is people say, yeah, hey, you don't understand. We've got this national inventory shortage here in the US. I think Zillow just recently put out a report saying that they estimate it to be a shortfall of somewhere around 4.5 million units in the country. So what's your answer to that? Because you just mentioned that at least in Texas and Florida, all of a sudden supply is really starting to come onto the market. Do we truly have a national housing shortage that's going to keep prices elevated, or is that a bit of a misnomer?
Absolutely not. I would call those type of narratives deceiving because while it would be true to say that in certain states like California and Massachusetts, yes, there's a housing shortage in those states, there is no broader national housing shortage. In fact, we're seeing quite the opposite occur right now. And I'm actually going to share my screen so you can see what I'm talking about here, Adam. Can you see the map on the screen right now of the
We
different
can,
states
and
in
I
America?
just want to make it clear right at the start here. This data, and I'm presuming more charts you'll show in a bit, are all coming from your reventure app that you developed.
Correct. This is from reventure app. This is a web application that you all have access to at www.reventure.app. But really what I want to show you folks here is the inventory growth year over year, the growth in homes for sale year over year in the different states across America. And what you can see more broadly is that pretty much every state is seeing an increase in inventory, an increase in homes for sale. But in particular, these states in red, like Arizona, inventory is up 68% year over year, going
Wow.
from 15,000 to 25,000 homes. So, and when you think about housing shortage, this most certainly does not apply to Arizona. Inventory here is skyrocketing. The same goes for Florida. Inventory is up 70% year over year. And you can see in many of these states, like Texas, for instance, the number of homes for sale. I mean, just look at how much it's gone up. It is now at the highest level it has been in the last 7 years. And
So,
if we were to, if just one
sorry to
second at
interrupt,
it, and
but
if we were to get,
yeah,
I just want to say one more thing.
yeah.
And if we were to get even more specific and look at different cities, we would see in certain cities, the inventory is going up like a hockey stick at levels 20, 30, 40% higher than even they were before the pandemic.
That's exactly the point I was going to make, which is when you looked at Texas, we were, the inventory, these percentages are really big because they're coming off a real low, right? Where post-pandemic um, inventory just cratered to lows that we hadn't seen for decades and decades, right? So you would expect the percentages increases to be high as supply starts to come on. But now we're already in certain places well above where we were for the pre-pandemic baseline, right?
Correct. That's a key point to understand. So it's actually two things, Adam. One is, first of all, just seeing inventory up 70% year over year negates the idea that there's a housing shortage to begin with, right?
Mhm.
But then when you see it now at or above pre-pandemic levels in an environment where the home sales and buyer demand is in the tank, that's really telling you, like, not only is there no shortage, there's actually a surplus of homes on the market. There's a surplus of homes on the market. The months of supply of homes is rapidly increasing. In a market like Austin, the months of supply is the highest it's been in 12 to 13 years. And so we're seeing more and more of that happen in different markets across America. So if you're a home buyer or a real estate investor or just a seller or someone who owns your house and just wants to understand the direction of prices, understand that it's so important that you know those trends in your market because we're seeing many states and cities and even neighborhoods that are completely shifting overnight. Inventory is up in some cities. Inventory is up 1,000% the last 3 years.
Wow.
So this is a rapidly changing environment that's a signal of what's to come for the housing market more broadly.
All right. So this is really what I want to dig into here, Nick, is on the inventory side of things. Essentially, um, where could inventory go from here? If we're already seeing inventory sort of start to flood into the market now when we have a kind of a quote unquote frozen housing market, right? Where transactions have plummeted to lows that we haven't seen for, I don't know, decades or whatever, because housing prices have increased. They're now at levels of record unaffordability to the median aspiring home buyer, right? So what's going to happen when sellers uh, start getting off the sidelines, bringing their prices down a bit to start moving inventory, that alone is going to add a substantial amount of new inventory to the picture here, correct?
100%. You're spot on, Adam. The high mortgage rate environment and the low home sale environment is restricting inventory. So when mortgage rates eventually drop, who knows exactly when that's going to be? Maybe I'll have some predictions for that later in this video, but that will free up a lot more new listings to come to the market. So when that happens, inventory is going to spike even further. In addition, any type of potential labor market pain that could be coming in terms of layoffs or job losses could lead to mortgage defaults, foreclosures, or just forced selling or in short sales. So there's so many ways that inventory can actually increase further into the future. So the fact that we're already seeing this skyrocketing homes for sale level, and I'm going to show you, Adam, in some cities what's going on. It's mind bending. The fact that we're already seeing that now is a warning that things can get much, much worse in the future. And when I say much worse, I want to be clear, not trying to be negative here on the housing market, trying to actually kind of almost give you guys some hope if you're a buyer out there, and you've been waiting and you've been seeing these ridiculous prices in many markets like Texas, Florida, Tennessee, Arizona. Understand that relief is already on the way and the relief is coming and that prices in these markets should get cheaper.
All right. Okay, great. Well, that should be music to the ears of frustrated home buyers who've been waiting for an entry point here. Maybe a little bit scary to folks that are homeowners who are thinking that they might want to be selling at some point soon. Um, Maybe the last question on this, and then we'll hop on to the next one. There's sort of this narrative out there right now that, hey, all we got to do is hold tight until the Fed starts cutting rates. And then as lower mortgage rates comes down, those are going to propel home prices higher. If I intuit correctly, I think you're maybe thinking, no, lower mortgage rates, yeah, they may start facilitating more transactions, but that additional supply that they facilitate may actually end up driving prices down to move that inventory.
Sure. Sure. I think the way to think about mortgage rates is what's it going to take to get a first-time buyer back into the market? And if the Fed cuts rates one or two times by the end of the year, that should push mortgage rates to 6.5% from down from 7 where they're at right now. So they're at 7% right now. Maybe at the end of the year, they're at 6.5. Is that enough to entice a first-time home buyer back into the market? That's about an 8% decline in their monthly payment. I don't think so. Home buyer sentiment's at the worst rate in history, according to Fannie Mae, as well as according to the University of Michigan Consumer Sentiment Survey. I mean, the affordability is so bad right now, and Americans are so stretched and strained in their ability to afford things due to inflation, now being mixed with a job market that's looking increasingly insecure. Mortgage rates going down 50 basis points is not going to really do it for most home buyers. And so I am very skeptical of the notion that a couple rate cuts is going to push home prices up. I think rather the headwinds we're seeing in the economy that are developing is something that could just keep buyers on the sidelines, especially once home prices start going down. This is the other thing to understand, Adam, is there's this perception out there that once home prices start dropping, all the buyers are going to flood back in. But that's actually not what's happening in a city like Austin. In Austin, home prices are down almost 20% over the last 2 years. There's been no bounce back in buyer demand, and inventory is just continuing to increase. Prices now in Florida are really starting to go down in many markets. Buyer demand is not going up. In Boise, prices went down by quite a bit. Buyer demand really didn't go up. And so the other thing to understand is that when it becomes obvious in a housing cycle that we're in the down cycle, buyers all of a sudden realize that they have time on their side.
Mm-hmm.
And all of a sudden there's this FOMO or this competition that's gone. And rather it's kind of like, let's see how far the values could drop. And so, it's a bit of a long-winded answer, but I would be very skeptical of thinking that a couple rate cuts is all of a sudden going to propel the housing market forward when we're already seeing this big spike in inventory occur in about half the states in the US.
All right. Yeah, a lot of great points there. That one about the consumer, once they start realizing the prices are going down, they flip into, well, let's see how far down they're going to go mode, right? And this is why um, policymakers are so fearful of deflation, because once deflation kicks in and prices start coming down, consumers oftentimes have the same mentality. And so, trying to stimulate them, trying to get them to go out and buy is hard because that waiting for lower prices gets entrenched. Same thing in housing, right? So again, we have these sort of conventional narratives. Oh, lower prices means that buyers come out of the woodwork. It doesn't necessarily work that way when you're looking at the actual cycles themselves. So, all right, great point. Here's my third sort of conventional narrative question that I'd like to see your response to. It's that, hey, you know what? The game has changed a bit in home prices these days, and home buying these days. Where now, besides just the regular person who's going to aspire to live in the home, there's so many other big pocket single family home buyers out there in the system now that the average, residential home buyer, they just don't matter as much anymore from a pricing standpoint. So this would be institutional buyers. This would be affluent folks who are looking to become expand their portfolio of homes that they're landlords for. It could be, the craze of folks that got in the short-term rental market who are looking to Airbnb these things. So, there is a narrative out there that says, housing is priced at the margin. These guys are the marginal buyers these days. It doesn't really matter that the vast majority of aspiring home buyers can't afford anymore.
Adam, with all due respect, anyone who's saying that narrative in the middle of 2024 is living in 2 years ago. Um, all those things you just said have completely flipped on their head. Real estate investors are not buying in the market anymore. Investor purchases are down 60% from their pandemic peak. We're actually seeing many of these investors sell. I'm going to show you actually a listing right now on Zillow. I went to this listing in Florida. Actually, I saw it for myself. It's in a town called Punta Gorda, which is on the southwest side of Florida. Important that you guys pay attention to what's going on in this listing. You can see it's on the market for 336,000, 3-bed, 2-bath, right? Take a look at the listing history here. First of all, take a look at the Zillow value estimate over time, right?
Okay.
You can see how much it's gone down. But what's really interesting is what this house sold for in May 2022. It sold for $445,000. So the current owner is taking a 25% loss 2 years later.
Wow.
Just so happened that the owner of this home is a company called First Key Homes. They own 48,000 homes across America. They're one of the top 10 largest Wall Street landlords in the country, selling at a 25% loss from what they bought it for 2 years ago in Florida. And so rather, the narrative that's applicable to the housing market right now is not investors buying, it's investors selling. There's many investors who bought over the last 2 or 3 years who bought at the peak who are now in distress. They bought rental properties, they can't rent them out. They bought Airbnb properties, their short-term rental revenues have plummeted. As a result, many of them are now being forced to sell their homes. And so I want to be so clear with people about this because the mainstream narrative is still, yes, oh, the Wall Street boogeyman is buying up homes. That is not happening right now. The reverse is happening. And ultimately, this is what also happens in the beginning of a housing cycle downturn. The investors, they were the first ones to pile in, push prices up. They are the first ones to get out. They don't own these homes for fun. They own these homes to make money. And if they're not being able to rent out the property and their rental rates are going down and their insurance costs and property taxes are going up and they're seeing the values in the market go down, yes, it makes financial sense to sell and get out in many cases. And that's what many of these investors are doing. So I would think that third point is actually the exact opposite.
So this is really interesting, Nick, because you and I have been following the housing market, for years, but I've interviewed you for years. This is kind of like a conversation I think we've been waiting to have, right? Which is, on the way up, when I would ask you about these institutional investors. One of the questions I would ask would say, how 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 uh, how much risk does this inject in the market when you have these big institutional buyers that own thousands and thousands of homes, and a lot of times, a lot of homes in the same metropolitan area, right? Where if they get distressed and they can't find another institution just to buy these properties in bulk from them, because these folks don't live in the house, as you were saying earlier, and to them, it's just really an Excel decision. Hey, you know what? These houses aren't performing the way we thought they would. They're now a drag. We got to get rid of them. The danger is that they could just dump a lot of inventory in a given market all at the same time, right? And basically just kind of nuke the current prices overnight. I'm guessing we're maybe early on in the stage of these institutions beginning to liquidate some of their inventory. But man, if we are, and they're already doing like 25% discounts in certain cases, I mean, how much further down could they push prices if they just decided, you know what, we're getting out of Punta Gorda entirely, sell every property we have there?
100%, Adam. And this is a risk factor that most people in the housing market don't understand. You're right. You and me have been talking about this over the last 1 to 2 years. There is so much risk from these investors facing more financial strain and needing to sell. And it's not just the big investors. The big investors are actually only maybe 20% of all the investor homes. The rest of the 80% of investor homes are like mom and pop or like medium-sized investors. So if like the big guys are having issues, you can bet that some of the smaller investors are also having issues. And yes, they tend to concentrate in the same neighborhood. And I want to show you a map right now. And this is, again, data on reventure app tracking inventory trends in different markets. And here we're looking at Houston. And you can look at any city in the US here on reventure app. But I want to show you what's going on in Houston because it really confirms this point you're trying to make. We're looking at a data point called the inventory surplus or deficit. How much inventory is higher or lower than the long-term average. And what you can see in these zip codes in red is that inventory is like double the long-term average already. And so let me just show you like here in 77026. Before the pandemic, we had 36 homes on the market for sale. Now we have 110.
Wow.
This is exactly what you are describing. This is an investor concentrated zip code in Houston where there's a massive sell-off occurring right now. And what you can see is that there's like a big concentration, in this case, to the north and to the east. Meanwhile, take a look at this bifurcated housing market and some of the wealthier areas to the west of Houston. You can see inventory still in a shortage, down 40% from normal, down 20% from normal, down 45% from normal. And so this is a perfect picture of the housing market we are facing right now. If someone's a buyer on the west side of Houston, they are still experiencing bidding wars. They are still experiencing a rising price environment. Someone's a buyer in these areas in red on the north side of Houston, all the way kind of up to the northern suburbs. It is not that way at all. It is a housing downturn. Prices are going down and inventory is skyrocketed. So I hope kind of that helps show you kind of what's occurring right now. And yes,
That's
it's those investor zip codes, which also happen to be sometimes lower income zip codes as well, where some of the local homeowners, unfortunately, tend to struggle more in economic downturns. And I think there's also some kind of local homeowners being forced to sell in those zip codes as well. And that's where the downturn is starting.
wow. And just to note, and I think you alluded to this earlier, this is all happening outside of a recession.
Sure.
Meaning if the economy continues to slow, if the jobs market takes a turn and unemployment spikes, it's an entirely different and entirely even worse game than what you're describing here. A couple questions around this. So one is obviously if you are looking to buy in an area, or if you're in an area as a homeowner and you're wondering where prices are going to go, a key question to ask is how much institutional inventory or how much investor inventory, sorry, is in this neighborhood? Because the higher the concentration of that, I'm assuming the higher the probability prices will go down.
I think that's a fair assessment. And honestly, I would keep it a little simpler, maybe for most home buyers. Understand the inventory trends in your market, right? Like if they are spiking right now, like, that's a telltale sign that the market downturn has started. There's fewer buyers, there's more sellers. Also look at the price cuts. One of the strongest indicators of the future direction of prices is the price cut rate, the percentage of listings in an area that has a price reduction. If you look at those two data points, which on reventure app, I combine them and some others to create a score for every zip code. But if you look at those two data points, you will kind of know the trends in your market in the short term. The other question to ask is, what's the fundamental downside, right? Okay, so we can technically say the market's doing up or down in the short term and will likely go up or down in the next 6 months. But what about like how much could prices actually drop in a worst case scenario? And that's a really important one to understand too. I track overvaluation rates for every city and zip code in America, how over or undervalued home prices are to their long-term norms, kind of similar to like a PE ratio with stocks, kind
Hmm.
of looking at the fundamental value there. And if you're in a zip code that's very overvalued and where inventory is spiking and price cuts are spiking, that says big downside risk. Conversely, if you live in a zip code that's not very overvalued or could even be undervalued, has low inventory and low price cuts, that says a stable market or one where prices could even continue to go up.
Okay. All right. So before we're done here, I'd love for you to bring up your app and show folks where they can find that sort of housing PE metric you just mentioned, because that sounds really useful. Two more questions on this, and then we'll get on to the next topic. So, over the past couple of years, the institutional investors or just the investor buyer has been kind of demonized, and perhaps for good reason, as, hey, regular people who want to buy a home are getting priced out because these investors show up with their all cash offers and they can bid more than most, average retail consumers. And so, this is growing frustration that these damn bastards are, hoovering up all the good inventory. I wonder now, could the investor seller be your best friend? Could you go to the first key homes or whatnot and look at their properties and say, look, it looks like you're selling around here, guys. How about cutting me a deal on this one here?
Yeah, most definitely. We've reached that point in the cycle where the investors are now going to be more your friend in terms of the sell-off. The one thing to understand, though, is at the bottom of the downturn, the investors will be back
Mhm.
buying, right? So the ones who are really getting hit right now are the ones who really expanded their portfolios in 2021 and 2022. That's what First Key Homes did. Um, Other investors like Invitation Homes, they didn't really buy as much during the pandemic. They're more secure. And I bet you, speculating, I bet you some of those investors are probably going to scoop up some properties once values go down enough. So I think it's still a mixed story on the investor. On one hand, yes, these investors will be cutting prices in many markets and pushing inventory on the market. It'll be good for you as a buyer, but don't forget, they'll be back. They'll be back at some point once prices drop enough. Because basically, the way these investors work is they're cash flow oriented. So they buy a house and rent it out. And right now, they get at prevailing market prices and rents, they maybe get like a 4.7% annual return. Take the rent, deduct the expenses, divide it by what they purchased the property for. That's not very good. And so a lot of these investors, they want like a 6.5. They need a 6.5 in order to be able to even participate with where interest rates are. And so
Hmm.
for that to happen, the prices need to drop 30%. And so I think once the prices go down enough, you will see some of the investors eventually come back in, but it's going to take time. It's going to take time to happen because home prices operate on a lag. And I see this actually in my home market of Nashville, where I live full time. The inventory in Nashville spiked. The price cuts have spiked, but there's still actually many sellers who list their house like at a crazy price
Yeah.
and who are just completely ignorant of what's going on in the market. And that's because many sellers on resale homes, they just get so attached to their house and what they think it's worth. And literally, in many cases, it takes years for many of these sellers to get with the idea of where the market is. Whereas the investor or the builder, they're much more objective. They're much more about just finding the market clearing price to sell. So understand that there is also a lag, and that lag often takes years. And housing downturns often take years, which is another interesting topic unto itself, like when the bottom actually might be.
Yeah, it's funny. They say the stock market takes the escalator up and the elevator down. The housing market kind of takes the escalator in both directions. Maybe even a little
100%.
faster escalator up than down. But you're right. It takes a while for these things to bottom out. Um, so one of the questions people always ask when you're in a down cycle, like it looks like we're now finally demonstrably in, is, well, geez, Nick, how long is this going to take and how low is it going to go? And nobody knows for sure. We can guesstimate on it, but I think a really good early indicator that we are approaching the bottom or in the vicinity of it a little before, a little bit after, is that these institutional buyers will start coming back in. right? So, Nick, it'd be great, I'm just asking you for the future, if and when you see that, if you can come back on the program and let us know. It might be a year from now, 2 years from now, who knows? But that'll be a really good sign, a sign of green shoots, I think, for the housing market.
Yeah, and let me actually just show you a graph related to this. This comes from Redfin. Redfin covers data on investor purchases. And this is just the aggregate number of investor purchases tracked by Redfin. And so what you can see is the big run up, right, during the pandemic, right? And then it plummeted. It plummeted now to like its lowest level since 2015. And so to your point, if we look actually what happened in the last housing cycle, investor purchases peaked in '05, 3 years before the crash really got going.
Mm-hmm.
And then investor purchases started going down and down and down. And it wasn't actually until around like here, mid 2018, when home prices really started to drop.
Right.
But you could see the
2008,
investor
2008,
cutback.
not 2018, but yeah.
Sorry, 2008. I apologize. 2008. But you could see the investor downturn in purchases really led that. Um, and then it kind of stabilized. And really, we didn't see an uptick in investor purchases until 2012. This is when some of those big Wall Street funds started getting into the market. But for sure, to your point, there's definitely a correlation between, and that was the sign actually that the bottom had passed. The bottom was in 2012, and the investor purchases spiked. Um, but I guess my point is, I'm not expecting this number to shoot back up anytime soon. I mean, short of some dramatic intervention by the Fed, say they cut interest rates like 3% and start printing money, maybe that could happen. But I'm expecting another couple of years of this. And then to your point, eventually, once we hit the bottom, we should see the investor purchases start going up again.
All right. Okay. Well, that'll be a really interesting indicator to look at. All right. My other little question here is this is a belief I have from having talked to you and a bunch of other folks in real estate, but correct me if my belief is wrong. But one of the things that we didn't see as much as was expected was boomers really downsizing, or let me say this, selling their homes to downsize, right? And what they were doing is either staying in their homes or they were downsizing, but they weren't selling their prior home, and they were looking at it more like just an asset in their portfolio, right? Hey, the price keeps going up. I can rent it out. It can be cash flowing for me. And I think more boomers over the past, decade or so kind of became more aggressive dabblers in real estate investing than maybe prior generations. And so, in addition to having the institutional players this time around, in addition to having your experienced mom and pop landlords, we now have this cohort of boomer landlords that are relatively new at it, right? Meaning they've been in it in the last 5 to 7 years. Maybe they just have their prior house that they sold that they're holding, or sorry, that they moved out of that they're holding on to. But maybe they bought a few other properties because everybody's been saying, hey, real estate's, great asset, going to the moon, whatever. With those type of people, they look at those assets as part of their, retirement portfolios. And I wonder if you just think that if you agree that what I just said is true, does that add any sort of meaningful dynamic here? And one ways in which I think it could be meaningful is, you're holding on to it because you believed it was going to be this great asset. But then all of a sudden you get to a point where you're like, wait a minute, this thing, like prices are now down 20% in my neighborhood. I need to liquidate this thing because it's my retirement and I can't
Yeah.
lose any more equity in this thing. And then all of a sudden you get, again, a wave of forced selling because it's desperate boomers trying to hold on to whatever remaining equity they can get.
100% that increases the risk factors in the market. I mean, the principal way to think about it is that the more houses you have that are owned by people who don't live in them, the greater the chance that there's some type of volatility in the market. Because ultimately, what it means is that there's more external factors at play influencing those homes being listed or not listed that have nothing to do like with the someone just living in the house. If I just live in my house and maybe I lose my job or I come to tough financial times, I'm going to scratch and claw to stay in my house, right? Like I'm going to scratch and claw to stay in my house.
Yeah.
If I own 4 or 5 investment properties that I bought over the last 10 or 15 years, and I run on tough financial times, selling that fourth or fifth investment property is a much easier decision than the other scenario where I'm living in my house and I have to leave my house. So I totally agree with you. And if you don't mind, I actually want to show you another data point that we track here on reventure app. It's called shadow inventory, which looks at the percentage of houses that are absentee owned units that are seasonally vacant or just completely vacant. We track it by state. You can see the Midwest is kind of very few absentee owned units. There isn't as much speculation there. There isn't as much market downside. But I want to focus on a market like Florida, actually, because you can see what's crazy in Florida is that you have you have a market like Naples. A third of all the houses are absentee owned units. In
Wow.
Sarasota, 18% of all the houses are absentee owned units. In Miami, where I am right now, 11% are. And if we actually kind of zoom in here on the zip code map, I mean, we could see, oh, you get close to the beach, 50% of the houses are absentee owned. And so the higher the absentee ownership rate and the shadow inventory rate, and you can see it varies significantly just even within a city, the more downside risk there is. Because think about someone who owns a beach condo or a beach house somewhere in Miami, their insurance and HOA costs just doubled, right? Their carrying costs just doubled, and it's their second or third house. Very easy for that person to make the decision to sell. And so I think to your point, this represents a lot of potential downside. This represents kind of like you said, the boomers who own 2 or 3 homes. Maybe some of them are vacation homes, some of them are rentals. You can see it's a lot of beach destinations have a lot of absentee ownership. These are markets that actually got hit really hard in the last downturn as well. Wouldn't be surprised if they get hit hard again. And so, yeah, I think there's just so many different angles for inventory to spike, right? The investors, the Airbnbs, the builders, the like you're saying, the boomer owner that has 4 or 5 properties and they're relying on it for their retirement. There's so many different angles where inventory can spike. And just here's a number for you. There's 27 million investment properties in America, according to Atom Data Solutions. 27 million investor properties in America. That's a quarter of all houses are investor properties. So it's not even like you need that many investor owners to have issues for inventory to spike. You just need like 5% of them to run into some type of problem for all of a sudden inventory to go up really fast. But of course, totally depends on your city, totally depends on your neighborhood.
Yeah, so there's just so many different pins that could pop this real estate price bubble. And again, we haven't really even gotten into the impact that a recession could have on all this. But you mentioned something else I want to just quickly get your thoughts on, which is the cost of homeownership has skyrocketed over the past couple of years, right? Insurance, property taxes, maintenance and repairs, all of those have gone up pretty tremendously. I was going to say dramatically, but I think in certain cases, tremendously. I mean, we hear stories about insurance rates that are like doubling or tripling in certain cases. So that just by itself, just mathematically, should be bringing home prices down anyways, right? It's like increasing the discount rate. It's just, hey, these things cost more to own than they used to, and therefore sell price should come down. How big of a factor is that on the market right now?
Huge, absolutely huge. It's no accident that inventory is going up most in a market like Florida, because that's a market where homeowners are getting crushed by higher insurance costs, higher HOA costs. And so, a market like Florida, you could actually, Fed could cut rates, we could avoid a recession. Florida is going to continue to see inventory spike no matter what, due to these higher costs for homeowners. In some ways, it's kind of similar to what happened in 2008. We had these adjustable rate mortgages. All of a sudden, the cost of the mortgages went up very rapidly. In this case, it's not the cost of the mortgages going up. It's the cost of your insurance and HOA and property taxes all of a sudden going up very rapidly. And this is something that's causing a lot of owners to be forced to sell. This is happening also in Texas. This is happening also in Arizona. It's also happening in Tennessee. And really, a lot of these Sunbelt housing markets is where those costs went up the most, because Insurance is heavily a function of the value of the property and of the structure, right? And then property taxes are also a function of the value of the property. So in some of these Sunbelt states, the prices went up 50 or 60% over 3 years. Well, that's going to flow into all those other costs, right?
Exactly.
That's
Yeah.
going to flow
People just don't
into
think, yeah, they just didn't
It's going to
realize that.
flow into your property tax bill and your insurance bill. And actually, someone commented on my YouTube channel once. I thought it was super smart. He said, if I'm living in a house for 30 to 40 years and I don't plan on selling it, he's like, I actually don't want to see the value go up. Because if the value goes up, I know my taxes and insurance are going to go up.
Yep.
If the value doesn't go up, I know my taxes and insurance aren't going to go up as much. And I thought that was super interesting. It's a very counterintuitive point because I think most people like will want to see the value of their house go up, right? But from a pure dollars and cents, cash flow and expense angle, rapid appreciation like we saw in the Sun Belt during the pandemic, it's actually has high cost and consequence to homeowners in the long run.
Okay. All right. So now's the point in the discussion where I ask you to pull out your crystal ball and tell us, sort of where you think prices are headed in, roughly when we get to the trough of this thing. It might take a couple of years. How much of a haircut from the high do you think the housing market will take on average nationally? Of course, your mileage is going to highly vary locally in this story. Um, but I think the last time we talked, Nick, you maybe were thinking maybe like about a 30% or third national average when the dust finally settles on that. Are you still in that general camp?
Yeah, I mean, we're basically 30% overvalued on the US national housing market. I think I'm maybe dialing that projection down a little bit due to the fact that inventory in the Northeast and Midwest is just really stubborn. So like in the Northeast and Midwest, and I'm going to pull up reventure app here so you can see kind of my what I'm talking about. So like in the Northeast and Midwest, right? New York, Pennsylvania, Virginia, like we're like 10% overvalued in these markets, right? So I could see like a 10% correction coming in these areas. The problem is the inventory. We're still at an inventory deficit here, and it's not really improving. So this is, I think, the one thing that surprised me a bit. Like I always knew the Northeast and Midwest would fare better than the Sun Belt. But inventory here is just still so low. Like in Connecticut, I think you've spent some time, Adam. Inventory is down 58% from its long-term norms. And so if we're in Connecticut, where before the pandemic we had 16,000 homes, now we have 3,800 homes. I mean, it's hard for me to project any type of downturn there in this current environment. Our forecast score on reventure app is saying prices are going to go up because of this. Same thing in New Jersey. In New Jersey, we were at 44,000 homes before the pandemic. Now we're at 13,000. And so, we go back to that discussion of housing shortage in the beginning. There is a definite housing shortage in New York and Connecticut. You can't argue in New Jersey. You can't argue that. And these markets are not as overvalued, 13% overvalued. So I would say at some point in these markets, maybe there's eventually a correction. It will have to take a recession, though. It will have to take a recession that dislodges some of that inventory shortage in these markets in the Northeast. Meanwhile, if we go to the Southeast, you can see like Tennessee, Georgia, Florida, home prices are 30% overvalued in these markets. Some of the most overvalued home prices in America, while inventory is now up from the long-term norms in all these markets. So for me, I'm saying in the short term and the long term, these markets are going down due to skyrocketing inventory and the fact that prices are already very overvalued. You can lump Texas into that as well. You can lump Arizona into that, as well as some of these mountain states like Colorado, Utah, and Idaho. Now, the interesting one is California. Inventory in California it's improving. It's improving, right? We see a bounce back in inventory in California. But we're just now getting to the 7-year average, and we're still below where we were before the pandemic. And so I'm kind of have a stable forecast in California over the next year. We're going to have to see this inventory get higher, and we're going to have to see the price cut rate in California get higher as well before we can definitively say prices are on the decline. However, once that happens, Home prices across California around 18% overvalued. To be clear, very expensive no matter what in California. It's always been expensive. They're 18% higher than their long-term norms. And so, and I'm not trying to not give you a national answer, Adam. It's just like, it's hard to give a national answer when there's so many differences in these local housing markets.
And that's
But
fine. A
more,
national answer isn't that helpful to people. So
yeah,
seeing that map, everybody can kind of look at their general region. So that's super helpful. All right. Well, look, so you are in Miami right now. Presumably your investigations have taken you down there. Why'd you go down there and what are you learning?
yeah, great question. So I do a lot of on-the-ground research and on-the-ground reporting in these local housing markets. I go and find listings on Zillow. I talk to people. I look at the data on reventure app. And what I'm finding in Miami is a little scary, actually. So the inventory here is going up. Miami-Dade is still in an inventory deficit a little bit. But one thing, I keep talking to locals down here who moved here in the last 1 to 2 years. And the one thing I keep getting is that they're all struggling, like lots of people who were laid off from their job, lots of people who have like four side hustles
Mhm.
trying to just make it. And this is more of a qualitative observation, right? It's not rooted in the data, but I'm just seeing it down here. I'm saying to myself, in a real recession, this type of market where the housing demand is coming from, you know, people who just moved here over the last 1 to 2 years without really a plan, this type of market could get crushed
Mhm.
in a real recession. Whereas like a market like New York City, home prices in New York City have actually already gone down 20%. But in a market like that, it's like you talk to people, it's like they work for Goldman Sachs and they work for a tech company that's like pretty large. Like, it's more like, okay, like they have a real job. More and more I talk to people down here in Florida, it's not that way. And there's nothing wrong with that lifestyle, but it just says to me there is more risk for the local housing market from a macro and economic perspective. The other thing I'm noticing too is that the inventory, I mean, it's wild how much the inventory has gone up in certain parts of Florida. So I was just in Cape Coral, which is on the western coast of Florida. And I'm going to show you this, Adam. I filmed a video in this zip code, 33993. Take a look at the inventory story here.
Oh my God, it's up over 10 times since
3 years
2021.
ago, there were 76 homes for sale in this zip code. Now there's 800. And you could see it's just crazy how much it's gone up. And so when you see something like this, and you see that the prices have still only gone down like 5% or something, you just know that there's more downside coming. And again, these are kind of like the weakest, most speculative markets get hit first. Um, but actually at a metro level, if you don't mind, like Tampa St. Pete. I mean, this is a pretty big market, right? Tampa St. Pete.
Mhm.
I mean, the inventory in a year it is almost doubled to now the highest inventory that we've seen since 2017 in a very big market, right? So this is not even just like smaller market, like this is happening in big markets in Florida as well. Um, yeah, I mean, this says heavy downward price pressure in Tampa. This is the home price forecast score we have on reventure app. It's 0 to 100. It's below 50. More likely the prices drop based on these underlying characteristics. And so, yeah, the on the ground research here is telling me that there is lots of downside, both from me looking at listings, looking at the data, and then also talking to locals.
Wow. I mean, some of these markets, just the way you're describing them, feel very much like the Wile E. Coyote moment, right? Where they're hovering there in midair. You can see the inventory spiking. Prices haven't quite come down that much yet, right? But you're just seeing the math and thinking, oh gosh, these people don't have a great future ahead of them. Um, so now let's trundle into okay, what happens if a recession arrives, right? That has substantial job loss. And I'll let you just answer that however you want. One thing I just want to note is you talked about the people you're talking to right now who have like four side hustles, right? And we're seeing that a lot of that in the official government jobs data, right? That basically there's been no new net creation of full-time jobs. All the net new jobs that have been created are part-time jobs, which really seems to be a sign of a weakening economy where people are having to get these side hustles just to kind of stay afloat. Um, in a recession, a lot of consumers who are currently door dashing it who aren't going to be able to afford DoorDash, right? They're going to constrain their spending. So a lot of those side hustle people, they may find, hey, if I'm driving Uber, if I'm doing DoorDash, whatever, that may dry up on me. I mean, it's a sad state of affairs to project, but I don't see how that gets avoided in a real recession. And so to your point about feeling like the people you're looking at are maybe more vulnerable than they realize, I'm right there with you.
Yeah, and can I tell you how I relate this to the housing market, Adam? So, how do you relate macroeconomic stress and distress to the housing market? I think intuitively people know more job losses, less consumer spending. It's not going to be good for the housing market and home prices. But I want to show you something. It shows just how fragile the housing market is to the mainstream economy. So we have a data point on reventure app called inventory as percentage of houses. So you can see how many homes are for sale as a percentage of all the owned homes.
That's a
And
great rate.
and
That's a
so
great
like
metric.
so in Texas, right? The inventory is spiked. We're now to 1.4% of all houses on the market, right? In Florida, we're at 2% of all houses on the market. And so understand that the difference between a high inventory environment and a low inventory environment is 1% or 1.5% of the houses. So we're back to 2% in Florida. It's going to be even higher in future months. If there's a recession in Florida and only 1% of homeowners are forced to sell their house, that will destroy this housing market. Look at California. California might even be more exposed. There's only 0.6% of all houses are on the market in California. So if 0.5% of all homeowners in California have some type of issue where they're forced to sell, inventory would double. So understand it's a very narrow margin for error on the housing market versus the real economy. And that we do not need to see that many people face distress to then have huge housing market ramifications. And the one mistake everyone seems to make, a lot of housing analysts make this mistake. They say, oh, this is nothing like 2008. They say, we're not going to see 10 million foreclosures. I should say 4 or 5 million foreclosures again. And that's true. We're not going to see 5 million foreclosures again. But that's not the point. The point is inventory went to such a low level and the prices went up so high that narrow bounces back off that are now having big downward pushes in certain housing markets. And it doesn't take that much for distress to spill into the housing market. So right now the foreclosure rate is around 0.5% of all homes in foreclosure. During the housing bust in 0809, it went to 4%. 4% of all homes in foreclosure. We don't need to hit 4% of all homes in foreclosure to have major issues. If we hit 1.5% of all homes in foreclosure in this cycle, there will be major issues in terms of forced selling and home prices dropping in many markets.
That is such an important point, Nick, which is it's tipping points that matter. It's not necessarily the volume. So in other words, you just need to have enough for the phase shift to happen, right? So your point is once you have enough excess inventory, that's when, true price discovery can happen, right? And so like you can drown in a bathtub, you can drown in the Pacific Ocean, right? All that matters is there's just enough water in there to drown you, right?
100%. And I actually just want to be clear about the timing too. In the last cycle, inventory started spiking in 2006. Prices started going down in 2008. Foreclosures peaked in 2010. So inventory in the last cycle started spiking 4 years before foreclosures peaked. Prices really started going down 2 years before foreclosures peaked. The foreclosures are not a lead. on the cycle, they're a lag.
Mm-hmm.
By the time you see the foreclosure rate skyrocketing, it's over. As far as like, it's not over in terms of the downturn, but it's over in terms of like, yeah, the market's going down, right? So don't wait to see the foreclosure rate go up substantially before you say, oh, like the market's shifting. No, it's going to shift before it's going to shift before that. It's already shifting now, and you could track the data for yourself just by looking at the inventory in your zip code.
All right, which obviously we can use the reventure app to do. So, Nick, so many other questions I'd love to ask you, but we're getting near the end of the hour here, so we'll start winding it up. What advice do you have to buyers, sellers, renters at this point in the cycle?
Buyers, if you're in the Sun Belt, exercise some patience. It's getting better for you. Um, Prices are very overvalued. Inventory skyrocketing. No need to be in a rush to buy in those markets. Over the next 6 to 12 months, there should be relief. Things should get better in terms of prices. If you're a buyer in the Northeast or Midwest, it's a bit more complicated. Still a shortage. Prices aren't as overvalued. I wouldn't expect in those markets to see as big a downturn. Um, if you're a seller, you need to be, I guess, very realistic about why you're selling and how much you want to sell. Like if you're trying to sell in Florida right now and you need to sell, you need to understand what's going on in your market. And if your market's going down or it's like inventory spiked, you got to price your house fairly, right? Like coming in with this idea of I'm going to price at what my neighbor sold for 2 years ago, that's going to lead you to being on the market for a year. So if you're a seller, I would say, have some discretion and understand what's going on in your market before you set your price and be realistic. If you're a renter, um, things are actually getting better for you in many markets in the Sun Belt. Rents are going down in many markets in the Sun Belt. Lots of concessions, big pipeline of apartment deliveries occurring. If you're a renter who wants to buy a house, I would also say exercise caution. The housing affordability is still the worst it's been in 40 years, and the cost to buy is much higher than the cost to rent in most markets. And so that's not to say like you shouldn't buy at all, but like, do those financial calculations. Like what's your cost to buy? What's your cost to rent? And if you were to buy in today's market, like price in, maybe the value of your house could go down 10 to 20%. And, say to yourself, like, is that worth it for me to take the plunge? So you can make a more educated and informed decision.
All right. In just a second, I'm going to ask how folks can get the reventure app and follow you in your work. But before that, because there's so many questions that I could ask you, Nick, is there anything that we haven't talked about yet that you'd like to just make sure folks understand before we wrap up?
Adam, I think you did a great job with this interview. I think we covered pretty much all the questions.
All right, good. All right, well then, how can people who have really enjoyed this conversation follow you in your work and get your app?
Yeah, so you can follow me on YouTube on the Reventure Consulting YouTube channel. And if you want to look at this housing market data more specifically for your area, you can do that by going to www.reventure.app and type in your city or just type in your zip code and just start looking at the data. Inventory trends are free. You can look at inventory levels and home values for every zip code in America. You can see we're looking at Los Angeles right now. You could see how it's trending over time. So you can see the trends in your market as well as the home price forecast score. And then there's more premium data points like the overvaluation rate, that home price to income ratio I was telling you about before, which is kind of similar to a PE ratio for stocks. We take the home value, divide it by the income, and we look at how that's trended over time in every zip code to establish whether a market is overvalued or undervalued. And then you also want to look at those price cuts. We have a lot of different data points on here in terms of understanding the direction of your housing market. But the inventory, the price cuts, the overvaluation rates, those are kind of the key ones for you as a buyer or investor. So yeah, www.reventure.app if you want to dig into this more.
That is such a phenomenally useful tool. Nick, I remember when it was in development. It's just so wonderful to see that out in the world and delivering so much value. All right, so when I edit this, Nick, I will put up links there to your YouTube channel and to your app download URL. Folks will also have those in the description of the video here too. So if you want to just get there with one click. Nick, it is always such a pleasure talking with you. I've got one last question for you that I'm going to ask you in just a second. Real quick, I'm going to do 30 seconds of housekeeping. Folks, if you've enjoyed this discussion, would like to have Nick come back on again in the future whenever his data is telling him there's something really meaningful going on in this now apparent down cycle in housing, please let him know that by hitting the like button, then clicking on the red subscribe button, as well as that little bell icon right next to it. If you've got questions about what to do with your own home buying or selling strategies, obviously those are big decisions, big financial decisions, and should be taken into account with your entire financial situation. So highly recommend that you tap the expertise of a professional financial advisor in determining what the right steps are for you. If you've got a good financial advisor who understands all the issues that Nick and I have been talking about here, who can do that for you, great. Give them a call and listen to what they say. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with the financial advisors you see with me on this channel week after week. To do that, just go to thoughtfulmoney.com, fill out the short form there, and those discussions are totally free. There's no commitment to work with those guys. It's just a free public service that they offer. By the way, when you're at thoughtfulmoney.com too, you can just click the newsletter link right up on top to sign up for our free newsletter. All right, Nick. So a closing question here is, you're younger than most of the folks that appear on this channel, which speaks, I think, volumes about your intelligence and what you've been able to do with your career so far. What's a big lesson you've learned so far along the way in your journey that you think is worth sharing with the audience here?
First thing that's coming to my head is don't compromise. If you have a passion and you have a purpose in life, like just pursue it. That's like the biggest thing for me over the last 5 years, from when I left my old career to figuring out this one. It was always very much, I did what I needed to do and went where I needed to go, even if it didn't totally make sense in the moment, and or at least in a rational way for most people. And so, I just doggedly pursued what I thought I needed to pursue. And, it's been working out so far, fortunately. And so I'm a big believer in that, big believer in intuition and kind of following your passion. So I think that's my biggest takeaway from my experience that, I can give to other people.
All right. I think it's a really good one. And having known you for as long as I have, Nick, I've seen over the years, as you've sort of faced decisions, made big decisions in your business, that you have done it your way and that you haven't compromised. And I think the end result is you run an operation that is completely optimized around you and what you want it to do and what you want your life to be like. So I think you've been hugely successful in that. You've been a great model for me and for the many folks that have followed your journey.
Thank you, Adam. I appreciate that.
Hey, real pleasure, my friend. All right. Well, look, until the next time you come on the channel, just always enjoy these discussions, Nick. Thanks so much for just leaving it all in the field here, giving so much of your perspective and your data and your wisdom to folks. Good luck until your next geographic journey, whichever city you're heading to next. I can't wait to see what you find out in that one as well. And like I said, doors always open here for you to come back on anytime you want.
Appreciate it, Adam. Probably heading to Texas next. So.
All right. Well, I can't wait to watch your reventure YouTube channel and see what you learn there. Nick, thanks so much. Everybody else, thanks so much for watching.